Hey everyone, in today's video, I want to talk about real estate investment trusts, otherwise known as REITs. Now, I own REITs, and as you know, I'm a super active real estate investor. I own a buy and hold set of properties, residential real estate properties, yet I still own REITs, and there's a reason why, and I'm going to explain it later in the video. I also want to talk about the things that I know a lot of people don't like talking about, but there are some risks with REITs, and I just want you to be super aware of it, just so that you know what you're getting into. And then the third thing, which is the most important thing, is what to absolutely look for before you invest in a real estate investment trust. So if you are looking to add some side income to your stock portfolio, like collecting money every single month, like who doesn't like doing that? Or you're just looking at, hey, what is even a REIT? Then you better check out this video because it's jam-packed with valuable information. So what is a REIT? So essentially it's a company that buys real estate, and then you can invest in this company, so then you become indirectly a real estate investor, except you are not a landlord. You just push a button, buy the stock, collect some juicy monthly dividends, and then go to sleep, and you still collect that income without lifting a finger, which is completely opposite of what I am, which is I'm a landlord and I actively participate in my real estate investment portfolio, meaning sometimes I'm a handyman, sometimes a property manager, sometimes I'm a marketing person. But of course, there's a lot more upside if you're an active real estate investor. But anyway, today's video is all about becoming a passive investor in real estate. So REITs offer you that opportunity. You can invest in office REITs, which are real estate investment trusts that invest in offices, or you can buy a REIT that does commercial properties, malls, or healthcare. The list is humongous in Canada and across North America. So there's plenty of opportunity to invest in real estate without actually lifting a finger other than pushing a button and putting money into it. So back in the day, the only way to do this was invest in mutual funds. But as of 1993, they've turned these mutual funds into these trust funds, and there's rules about being a REIT. Now, a couple of rules to become a real estate investment trust is, first, well, the majority of your holdings has to be rental properties. It could be office, it could be commercial, it could be healthcare, but the fact is you need to own the majority of real estate in the portfolio. Second, in order to be a trust fund in Canada, you have to distribute 85 to 90% of your rental income, being the profit from it, directly to the shareholders. That way, these trusts can actually avoid taxation. But there's a caveat to it. It gets taxed to the person who receives the income, which are shareholders, which I'm going to talk about a little bit more later on. So what are the dangers with REITs? Now, I don't want to scare anyone. I just want to make sure that you go in with eyes wide open, because with any investments, there's always risks involved. And so I just want to be super clear on the things you want to absolutely look for that are very dangerous in a real estate investment trust investment. The first one is being over leveraged. Okay, it's like saying, hey, you are allowed to buy 5 properties with only 5% down, and you could do this every 3 months. Okay, you don't obviously want a company, well, first, I want to say, obviously, it'd be amazing if you could do that, but to really pull it off and not actually go bankrupt, well, that's really hard to do. And that's what you don't want in a company that invests in real estate, where they completely are over leveraged. So the way to mitigate this is actually look for a company that's making very smart acquisitions. Maybe they're adding value by renovating it, or they're adding value by changing a commercial property and adding residential properties to it, or changing density. There's a lot of things to add value to a real estate portfolio. But say you didn't know like a lot of details, there is a metric that you can absolutely look for, which is its AFFO, which is adjusted funds from its operations, which is basically saying what is its free cash flow from its operations. So if the REIT is doing well, it will gradually increase its AFFO per share. So you're looking for an uptrend, not a downtrend, because when a downtrend happens, that's probably a bad sign, because they're probably diluting their shares, meaning issuing more shares to raise more capital to buy more real estate, and they're getting into trouble. So this is a quick, easy peasy way. It's just telling, is it making smart acquisitions? Because unfortunately with REITs, in order for those companies to grow and make a lot of dough, they always have to buy more real estate, or spend a lot more capital doing renovations or adding value to the land, which requires more capital. So you could easily see how a REIT can get into a lot of trouble if they don't know how to use their debt properly. And there are only 3 ways that they can do to raise more capital, which is first, issuing more shares, which is diluting the shares. 2 is borrowing more money from their equity or raising capital from private investors. But that means it always hits their bottom line, and it will hit their AFFO. Now, the next thing I would look for is the debt to asset value. Now, the way you'd find this information is in the balance sheet, which you could get Yahoo Finance or any other resource where you can get the financials for the past 5 years for that real estate investment trust, okay? So you wanna always look for a debt to asset value of less than 50%. It's like saying, hey, that they actually have enough real estate value that it's way larger than their debt. It's like saying, hey, you borrowed $1 million. If you had a debt of only, say, $300,000 or less than $500,000, do you think the bank would loan you more money when your real estate's worth $1 million? Of course. So that's what we want REITs to also do, so that they can continuously raise capital to renovate, to buy more real estate, and add more value to their REIT. And then eventually their stock price will give you more rewards, either through higher distributions or through capital appreciation. Now, the next thing you want to look for is its management structure. And I don't mean a boring art chart. What I mean is that you want to look for lots of insider ownership, like a company like SmartCentres. If you look at the insider ownership, you could see that the CEO owns a big controlling share of the company, which means that they're looking out for the shareholders because he's one of the big shareholders of the company. And another thing I look for, there's ongoing buying of his shares. So there's more buying, insider buying, than selling. Because one of the biggest dangers of a REIT is when you see a lot of insider ownership selling their stock, and or none of these management or very little management owning the shares of their company, which isn't a good sign. So that's a big danger. When you look at the management structure, look for large insider ownership. So if you don't see a management team putting their own money into their own company, that's a big no-no. Next big risk about REITs is that they're too concentrated in one major sector that isn't actually going to do well in the future. Some of the more obvious ones is shopping malls. So what I look for in a REIT is trying to concentrate in areas where it's trending, like warehouses, industrial land, because like Amazon is building a ton of warehouses all across North America. Or you might look for healthcare facilities, because that usually is a stable set of income. We're always going to need long-term healthcare. So that's the type of area that you may want to look into, versus completely 100% of your assets held into shopping malls, which isn't that great right now, especially during the pandemic, and actually see that dwindling in the future. So although I personally own riocan and SmartCentres, which has a big proportion of the real estate in the shopping mall areas, but their business model is changing into residential. And that's what I like. I love residential real estate because everyone needs a home to live in. So I love when a commercial business model is turning into more mixed use, like including residential. So bottom line, please, if when you're investing in a REIT, please know what the REIT is actually holding as its real estate. Where are the locations? What sector are they in? Are they in office, residential, commercial, warehouses, industrial, etc., so that you can sleep soundly at night knowing full well what and where they're investing in. Another thing you might have not known about REITs is that they don't increase their distributions that frequently, okay? This is not a dividend growth stock. This is like straight out, you just collect some predictable income every single month. But have you noticed that a lot of REITs don't increase their distributions that often, unless you got some exceptional growth REITs, such as Granite Realty, which is super rare. More times than not, you'll get something like a SmartCentres or a riocan, where they just always collect their rental income, they distribute a certain portion to their shareholders, and then it's a predictable source of income every single month. So that's the type of danger that I want to warn you. Don't expect like massive capital appreciation, the fact that its monthly distributions are going to grow for a very long time, because you could tell in history, riocan, SmartCentres, like those types of REITs rarely increase their distribution. So this is a bit of a warning, is that if you are looking to invest in REITs, don't expect the world of REITs, okay? Even though you might have invested during the pandemic, which is like high five to you, but Rarely will you get massive capital appreciation like you did last year, where you would have been rewarded like 40% plus return on investment in the span of less than a year. Okay, this typically never happens for REITs. So just don't expect massive growth, massive capital growth and distribution growth for the foreseeable future. You will see at least growth, at least keeping up with inflation, because real estate tends to go up with inflation. Rental income tends to go up with inflation, so you can expect a REIT to actually go up with inflation and maybe a little bit more. So with the bonus of the distributions, that's like double digit growth every single year, but we're not talking about 40-50% year over year increase. Okay, so this is a big warning for those who are investing in REITs and expecting it to shoot up to the moon, because these are not the type of stocks that shoot up to the moon. This is for income investors. I'm going to save you a ton of money. I'm going to talk about taxes. This is a danger investing REITs in the wrong account. Okay, so REITs are very complicated distributions. Of course, it's easy to collect the money, but their tax structure is quite complicated, because sometimes they return a certain portion of the distributions as a return of capital, which has capital gains taxation. Sometimes part of their distributions is paid to you as a dividend, which then gets taxed really efficiently. But it depends on where you're investing in this. So if you're investing in REITs, please at least invest in registered accounts. Always invest in registered accounts. And if you're investing in Canadian REIT, it's best to invest in a TFSA. If you're investing in a US REIT, it's best to invest in a RRSPs, because there's a 15% withholding tax whenever you buy a American company that pays you dividends or distributions every single month or every quarter. You're always going to get taxed 15%. So I think for tax efficiencies, I highly recommend, to avoid you losing more money, is to try to invest in Canadian companies in the TFSA and American companies that pay distributions in your RRSP. Now, if you maxed out your registered accounts, like your LIRAs, your RSPs, your RESPs, your RRSPs, and you still have extra cash, and you're thinking, should you invest in a REIT in a cash account? I would say it's not the most tax efficient. Sure, the monthly distributions are great if you're looking for extra income, but it's not the most tax efficient structure. So you may want to look at dividend stocks rather than a REIT, just because of the complicated tax structure. But of course, I'm not an accountant, I'm not a professional financial advisor. This is just some YouTuber who's just telling you my personal opinion. So please do your own due diligence, talk to your accountant. What is the most tax efficient structure for your REITs? So what makes a good REIT? Okay, so here are the key metrics and things that you want to look for to make a good REIT. Number one is debt to asset value less than 50%. So the way you find this is just look at the balance sheet like you see on Yahoo Finance, or you could download the investors' presentations of the financial reports, and you could always just do a search, debt to asset value, and you want to look for a history of less than 50%. Number two, you want to look for an AFFO, which is adjusted funds from its operations per share, that's increasing over time, not decreasing. And the reason why is because it's a quick litmus test to tell you, are they diluting their shares too fast and not keeping up with the growth of their cash flow, okay? Because you want, if they're making very smart acquisitions, then they're growing their rental income, which means it's growing their free cash flow back to you every single year. So you obviously don't want that to actually be dropping every single year. Next thing is make sure the distributions are safe so you can sleep soundly at night. So you want to look for a price per AFFO of less than 75%. This means that 75% of their funds from its operations is paid out to you, okay? And no more than that, maximum 75%, because obviously if they pay more than 75%, like they're entering in the 90% territory, then there's just not enough funds that they're keeping within the company just in case bad times arise. And then that means if bad times arise, then you don't want to cut their distributions to you, okay? So that's why you want a payout ratio of less than 75%. Now the next thing you want to look for is how predictable are their distributions? Have they always paid out their distributions? Because you want to make sure that they always pay it out. So hopefully they didn't stop paying distributions during the pandemic, because that would show that they're not that great at managing bad times. So you always want to show, are they paying their distributions every single month? So the best times to look at is during the 2008 financial crisis and recently during the pandemic, and see if they paid out their distributions. The last thing you want to look for is a high percentage of insider ownership. Either there's a lot of insider buying, there's also CEO that owns a pretty good chunk of the company because you want to make sure that management is putting where their money is at, okay? And they're looking out for the best interests of their shareholders, which is also themselves. So what kind of investors should consider a REIT? If you are a long-term investor, meaning you have 5 to 10 years to 20 years outlook, and you're very optimistic about land values, about real estate values, about property values, then you've always wanted to invest in real estate without getting your hands dirty, like becoming an active landlord like I am, then you might definitely want to look at REITs, okay? Especially if you want some predictable income every single month. But fair warning, these stocks never shoot to the moon. They're super boring, but predictable when chosen right. And if you haven't subscribed, why not? I love talking about stocks, real estate to grow your income, build your wealth, and ultimately help you design your ideal life. So please hit the subscribe button, that bell notification button. I'll see you in the next video.